Hey everyone, to start the new week, we want to have a look at the sort of technical picture of some of the major indices and basically looking at what we have now is very well-defined overhead resistance after a quite sharp rally off of last week's lows. So let me just get right into the charts and just show you a couple of things that we are seeing and then kind of go through what this general sort of technical juncture tends to tell us over time. So we're looking at the S&P 500, the SPY ETF, and what you can see here is a whole bunch of moving averages. I have a 200-day in red, I have a 150-day in teal, that's green. I have a 100-day in blue and a 50-day in yellow. And really what's really not that important is the exact absolute levels of those. What is important is what they're doing now, all four of them more or less collectively. And that is the following. You can see over time we had a pretty clear picture of upward moving averages from the lower left to the upper right. Some of them have since turned down, more notably than others, like the shorter the moving averages, the quicker it's turned down, the 50-day, for example. This is just really just what's important here is the visual big picture as opposed to the little intricacies. And so basically what we're facing with right now is an index that is, all else being equal, basically facing a lot of overhead resistance from a simple moving average perspective. And we actually think there may be a little bit more downside here before ultimately maybe we have a better rally attempt. Aside from that though, aside from the overhead resistance, what I want to point out is what happens to resistance, and it gets stronger as moving averages that have now again collectively moved up have altogether over time, over the course of a few months now, basically flatlined. So what you have is you have a trend break, a break in those moving averages, a break in breakdown in price basically. And as those moving averages are now flat, all of them, a couple of them already pointing down, that change from upward sloping to flat offers a lot more or a lot better resistance than if one were to like break below a moving average and then while all the other moving averages are still sloping up. Like for example, what happened in September of last year, we had a 50-day moving average break, a 100 moving average break, and then it was a matter of a couple of days and we were right back above it. This is a very different situation right now. Now, of course, we can get relief rallies if we get some good news out of, say, geopolitical risks or things like that. But for the most part, this is now a much more serious overhead resistance from a purely technical perspective than if you have just a couple of moving averages break for a few days or a few weeks. So it doesn't really matter whether we look at the S&P or we look at something like the consumer discretionary sector. They all look the same, right? You can see overhead resistance here a little bit higher in this particular case, but still it's all the same thing. Financials, for example, as well, the XLF. So you have a very defined level of overhead resistance now as moving averages have gone from upward sloping to essentially flatlining or even turning down. So I hope this is helpful, folks, and we'll see you again soon.